Hello, and welcome to the DoubleLine Total Return Bond Fund webcast, hosted by CEO Jeffrey Gundlach and Portfolio Manager Ken Shinoda. This conference is being recorded. Please allow me to introduce DoubleLine President Ron Riddell. Mr. Riddell.
Joining us, welcome to the DoubleLine webcast with Jeffrey Gundlach and Ken Shinoda, titled 1984. We have a few housekeeping items that I'd like to update you on. We have some new video content, so you can go to our youtube.com page /DoubleLine or doubleline.com, and you can view some of our new video content that's up there today. Ken Shinoda in Channel 11, titled The Rate Cuts Are Coming, The Rate Cuts Are Coming. And then also our analyst Ryan Kimmel has some content up titled U.S. Debt Spiral Watch. Ryan's also up with our client portfolio management team in the Perspective series. So again, you can go to doubleline.com or youtube.com /DoubleLine. Secondly, I just want to highlight upcoming next week during Fed Week on the Fed Day, Mr. Gundlach will be back on CNBC and Closing Bell at 12 o'clock Pacific Standard Time on the 18th of September. And then Ken Shinoda will be on Bloomberg Markets The Close, also on that same day at 1:30 Pacific Standard Time. You can see the rest of our webcast schedule for 2024 at doubleline.com. And the two upcoming webcasts, we have the Diversified Fixed Income webcast on the 8th of October, and then a Total Return webcast back up on December 10th. If you'd like to receive a copy of today's presentation slides, you can go to the Request Webcast Content tab. On the next slide, we also just want to highlight again, you can go to doubleline.com or youtube.com /DoubleLine, where you can view our Channel 11, as well as Perspectives with our client portfolio management team. And then we have those two webcasts, the widely acclaimed Sherman Show podcast and Minutes with Sam Lau and Jeff Mayberry. I want to highlight just real quickly, we're going to be talking about the DoubleLine Total Return Bond Fund today. So the fund offering, you can see the various share classes with different expense ratios and minimums. And lastly, just standardized performance on the DoubleLine Total Return Bond Fund. On the iShare, since inception, the fund was launched 4/6/2010 through the end of October of this year, an annualized return of 3.95 versus the Bloomberg US Ag at 2.51, which is an annualized outperformance of 1.44%, and also the Bloomberg US MBS Index at 1.99, which is an outperformance of 1.96 on an annual basis. Also want to highlight the net 30-day yield at SEC yield at 5.82%. So with that, I'm going to turn the webcast over to Mr. Jeffrey Gundlach.
Again, welcome to the penultimate webcast of mine for the year 2024. It's hard to believe that we're already barreling into year end. We do have another webcast that I'm not doing that's on our diversified fixed income funds. They'll be in October. You can see on the screen the image of Big Brother watching, and the title of this webcast is 1984. And I entitled it that a couple of months ago. And it came to me that I had not read 1984 in a long time. And so I started to reread it. And if you've never read 1984, it's harrowing, but you could try take a spin at it. On my reread, I got to about chapter 4 and I had to stop because I couldn't take it anymore. It was just too very similar to the world in which we're living today. What I'm going to talk about today is a little bit more narrow and a deeper dive into the subject of the Fed and some of the variables that will likely underpin their logic and their thinking for the meeting next week. It's interesting that since the Fed, in the last several Fed meetings, since the July meeting, the number one performing sort of standardized asset class is long-term treasuries, up 6.3%. Nothing else is up anywhere close. That the S&P gold is second best, I guess, at 4%. Since the June 12th Fed Day, the long bond ETF is also the number one performing standardized asset class, and since the May meeting. So the long-term treasuries have been a top performer now for going on 4 months. And interestingly, going back to all the Fed meetings over the past year, all of the rates on the yield curve, 2 years and on out to 30 years, are now down since the September 2023 meeting and every meeting since in through the July meeting. So here has been the volatility of the markets thinking about what the Fed might be doing in the future. So you can see that January 12th, 2024 is the red line, and there was a very aggressive Fed cutting cycle that was priced into the bond market as we entered 2024. Then you can see near the upper right, we see the June plot where they pivoted, and we also see April on there, and you'll notice that they were very different from where they were at year end, and they didn't change much between those time periods. And then all of a sudden, we had the Powell pivot at the last meeting, in which I said on CNBC, much to Scott Wapner's surprise, that I expected fairly quickly 150 basis points of Fed funds cuts within no longer than a year, and probably significantly less than a year. And now look at the black line, which is the current forecast using the shape of the bond market's yield curve. And we can see that it's actually even more aggressive on a one-year forward basis than where we were entering with a dovish market sentiment and entering 2024. So the red line showed from January 2024 through in the end of 2024, there would be about 180 basis points of rate cuts from 5.3 to about 3.7 or so. And now the black line, we can compare it 1 year forward, look out at September 2025, and the forecast is about 2.9%. And right now it's 5.0%. So it's actually 210 basis points. So it's 8 full rate cuts in the next upcoming 12 months. And this has been changing pretty rapidly. So the Fed has been very tight. Jay Powell said that in plain English at the July press conference, and we can see what he means by that in one chart. And this is the Fed funds rate minus the U.S. headline CPI. And we can see that it's the highest that it's been in basically almost 20 years, since prior to the global financial crisis. And it's been negative for most of this time period. The Fed funds rate was negative for over 10 years with small interruptions, and now we can see it's all the way up at 2.43. So the Fed is going to be easing almost certainly at the meeting next week, and we'll talk about why. I've always said that the Fed funds rate just follows the 2-year Treasury. The Fed just follows, and we'll notice that it actually sort of leads, the gray line leads the blue line most of the time, particularly in more recent cycles. It's led the blue line, the Fed funds target rate. And now we say that we're actually further ahead. In other words, the Fed is further behind, with their upper end of their range being 550, while the 2-year Treasury is now down to about 3.6. As of yesterday, I guess it was a little bit higher. But now there's this huge gap between the Fed funds rate and where the 2-year Treasury is guiding. And so no wonder the market is talking about the potential for a 50 basis point cut at the meeting next week. I don't have the chart on here, but you can also do the same thing for the Fed funds rate versus the 10-year U.S. Treasury. And that's even more out of whack by historical standards. Over the last couple of decades, there has never been a Fed cycle where the 10-year Treasury was leading the Fed funds rate so heavily. In fact, the 10-year Treasury is about 3.65. So we're talking about 175 basis points or so below the Fed funds rate. So this is unusual. I expect that unlike past initial cutting cycles, the 10-year Treasury probably won't rally as much this time because it's already discounted it in. We haven't seen anywhere near this gap prior to the Fed's first rate cut of the Fed funds rate versus the 10-year Treasury. So let's talk about what is driving the Fed's decision. They always talk about the dual mandate, and that is inflation and full employment or a strong employment economy. So first, let's talk about inflation. We're going to go into a lot of things here, and there's some strong takeaways. Here's the CPI, the headline, which is at 2.9%, and the so-called core, which excludes food and energy, which is at 3.2%. It's pretty obvious that these are in a declining mode. I would also point out that the DoubleLine inflation model, which has been pretty accurate, it factors in the cost of energy pretty heavily and some assumptions on shelter. But we now are looking at a very substantial drop in the headline CPI in the next 6 months or so, based on the rapid decline in the price of oil that has occurred over the past couple of months. It's actually down about 25% over about a 3-month period. We now predict that the inflation rate, the headline CPI, within a few months is going to have a one handle on it. It'll be below 2% if oil stays in the mid 60s. The CPI is going down fast. I wonder if that won't prompt the Fed to start talking about that they are undershooting on their inflation target, because if the commodity structure stays where it is now, it's going to stay below 2 for months at a time going into next year. And that doesn't even fully factor in a normalization in the shelter component, which we expect will happen. And I'll talk about that in a couple of slides. So here is annualizing the shorter term periods. And this became popular about a year ago when the Fed was looking for excuses to discount what was stickier inflation than they wanted. They started looking not just at year over year, but at 3-month annualized, 6-month annualized, and so on. And now we can see that the 3-month annualized headline CPI is below 0.5%, because we had 3 months of low prints. The core CPI is well below 2% if we annualize the 3 months. That's a very significant change from where we were in the prior quarters, because you can see if we annualize the 6-month numbers, it's actually 2.5 on the headline CPI, just slightly below the 12-month headline number. And the core number is up at 2.8. So the recent inflation data has been very different, and I expect that that will stay subdued based upon the commodity complex, which we'll take a look at in a few slides forward. Where's the inflation coming from? Well, here's a stacked bar, and you can see that the black line at 2.9 is right on top of the blue bar. So core services is the only area of the CPI that has any inflation at all to speak of. Everything else neutralizes out at 0. So if core services comes down, then assuredly the inflation rate will go below 2%, which is what our model is predicting. Here's the contributions to core inflation. Here we see that it's not just shelter, but it is the core services, basically ex-shelter is adding some amount as well. So there is 2 components here that are rising, unlike only the one really on a net basis for the headline CPI. But here's shelter inflation, and it's been coming down. It's been coming down. The core CPI ex-shelter inflation, that is, has been coming down. So if we take out shelter, which is the only thing that's adding to the headline CPI number, if we take shelter out of core, so we're slicing and dicing pretty finely here, but actually shelter without shelter in the core CPI, I understand that this represents less than probably half of what people spend their money on, but it is below 2%. And I'm sure the Fed is aware of this as well. More evidence that you could support the logic for a 50 basis point rate cut next week. But here's the kicker, and that is that the CPI shelter inflation, that's the dark line, it's up at 5.05%, whereas the new tenant rent index is actually negative 1.1. So there's a huge catch-up that is likely to happen from the urban consumers' housing and shelter component, because it over time, and this goes back 20 years, over time, not surprisingly, they end up in about the same place much of the time. When there's volatility, it looks like the CPI component tends to lag, and you get a lead effect from the tenant rolls. And so one would expect the shelter would moderate pretty radically. Again, good logic for a 50 basis point cut, given the huge gap between the 2-year Treasury and the 5 3/8 average middle of the Fed funds target range by the Fed. So here's another measure. This is one I think the Fed cares even more about. This is PCE, Personal Consumption Expenditure Index, and we see that it's also relaxed. It's actually lower, typically is lower than the CPI, but headline and core are virtually identical at 2.6 for the core, 1/10 higher than the headline rate at 2.5. But these both also have downward momentum and would likely also have the same type of behavior as the CPI as we factor in the lags on the shelter component. Here we are annualizing those shorter-term periods like we did in the prior CPI section. Here, they're not as low for the last 3 months, but they're still well below the Fed's 2% target. The headline is at 0.9, and the core is at 1.7. Here, the 6-month numbers are similar to the CPI. We have 2.3 on the headline and 2.6. So we're getting quite close to the PCE. I think this is what has Jay Powell saying he's got increased confidence that we're heading to the right place at the 2% target rate, although here the headline number seems to have stalled out. But with the falling commodity prices, we would expect that this would also head down towards the 2% level. There's seasonality in the core PCE, which I talked about a year ago, but here it is again. You tend to get a bump up on a seasonal basis, even though these numbers are supposedly seasonally adjusted. The fact is that they don't seem to be adjusting them all the way that they should be, because you can see that the first quarter is the highest inflation on a median. The second quarter is elevated as well, and then you have third and fourth quarter, which tend to be actually negative. So we would have a reason to believe that we're not going to be surprised to the upside because of seasonal effects on these inflation numbers that are coming out here in the fourth quarter of 2024. Super core inflation, this you never hear about. This is if you want to be an inflationist and you want to have ammunition to support the idea that inflation might reaccelerate or might not come down as the Fed is hoping for and that I'm predicting, you can say, well, look at the super core, which was rolled out a couple of years ago because they were hoping to ignore the high volatility on the headline CPI, so they started stripping out more things. So this is now core CPI less housing, which is at 4.48 on the CPI, and on the PCE, it's at 3.25. Yes, the PCE number is coming down, but it would be hard to characterize the dark line as really systematically declining on a trend basis since it's been going sideways for a year. So we'll see what happens and if anybody cares about supercore CPI anymore. Let's go to the more high frequency inflation data. Here's producer price indices, which lead the CPI and the PCE because these are wholesale prices and not seller prices. So it's in front of the actual production. And so we see that the PPI final demand got very low. It got down almost to zero, but it's up at 2.25. And we see that the gray line, which is 3.3. That's PPI final demand sort of core number. So these are still a little more elevated, but these probably were reacting to some of the strength in commodity prices a few months ago, and that is completely reversed. And so we would expect to see the PPI coming down as well. So there's a lot of logic for cutting rates if you're looking at the inflation side of the mandate. Everybody knows that I like the best export and import prices. These have been volatile for sure, as they always are, but lately they've been running below 2% at 1.7 for import prices and 1.4 for export prices. Nothing here to cause any concern about the 2% target somehow being reversed from the bottom to the upside. Also, here's the gasoline prices versus WTI prices, and this goes through yesterday. So WTI is at 66 right now. It's down over $2 on the day. And here it was a little below 69 yesterday. And not surprisingly, gasoline prices follow WTI prices. And so there you have it. We see that there's good logic to believe gasoline prices could be coming down. So not a lot of inflation coming from the very important energy sector. And here's commodities broadly, the Bloomberg Commodity Index, which had some strength there back in April, May, and June, but it was another false start for the commodity market. And we're right back below the 200-day moving average. And in fact, as of today, this was yesterday's print, we're down again today, we're at the low of the year. In fact, we're at the low for almost 2 years on commodity prices. So here we are without any inflationary signals. And that's even though the dollar has been relatively weak versus, say, the euro, it had come down some. So it's not percolating through into the commodity market, which is suggestive of weak global demand. So weaker global economy, and we all know that the Shanghai stock market has been very weak, and lots of problems in the Chinese economy, it appears. Now, here is an interesting chart. I put this on just for informative purposes because I think it's sort of interesting. We calculate CPI one way, and the Eurozone calculates inflation another way, their consumer prices. And our consumer price methodology differs from Europe's. We have more of an emphasis on housing in our consumer price calculations. The interesting thing here is Europe's CPI the way they calculate it is at 2.8. We saw that ours was up at around 3 or so. But if we calculated our CPI using the European methodology, we would calculate it to be 1.72, fully 108 basis points lower than European CPI using the same calculation methodology as they do. And it's fascinating that we have been reluctant to cut rates, whereas Europe has cut rates. And so we are kind of in a strange spot where we would appear to have higher inflation, and yet we haven't cut yet. Further motivation for cutting rates. I said they should have cut them last July, and I believed that then, and I believe it now. I think most people see that now, since we have this massive gap between market pricing and the Fed, which has been slow to react, being led by the market per usual. Now, here's the problem. Here's the problem in the economy and what the politicians don't seem to understand. This is the CPI level. This is not year over year. The index has a level to it. And you can see that both the all items blue line and the less food and energy line were going up kind of in sync with each other. And this goes back to, well, 1984. We're going to do a lot of charts being in 1984, which is one of the reasons this webcast is entitled 1984. We can see that, there's some variation, but all of a sudden you get to 2020 and you have this complete change of trajectory on the CPI, and it goes up by a lot, by 25% or so, or since 2020. And this is what consumers are feeling and why they're not happy. You can tell them all about how it's great that inflation is approaching 2%, but the price level is still up 25% from where it was 4 years ago. And that is a problem because people are suffering and they can't afford it. And there's many, many articles and stories about families where the parents are eating every other day because they only can get, with them skipping days, they only have to have their kids skip one meal a day. And this is what the problem is. It's the level of inflation. And it will take a long time for this to get back to sort of the longer term trend line. We would have to have sideways prices for quite a while. Another thing that got elevated right after the lockdown, was the M2 money supply with all that money printing. And this has the same look, and I say not surprisingly, same look as the CPI. Here we have the same deal. The money supply was exploded higher. It led to all that inflation. Now it's been going sideways for a couple of years. So it's quite sensible that inflation should be low for a protracted period because we don't have the money supply being gunned. And yet still, we don't have deflation because there's all this M2 above the long-term trend line that's been sloshing around in the system. And this is one of the reasons that I've been talking about why many of the traditional recession indicators have been either inaccurate and not helpful or lagged in the way that they've been helpful. And we're going to get to that in the next section. Another big problem is auto insurance inflation. Just imagine what the cumulative inflation is on auto insurance when you have a 19% increase for motor vehicle insurance year over year. And we can see that it's still rising high, pretty significantly on a month-over-month basis. So auto insurance looks like it's up over the last 2 years, something close to 40%. And that, of course, is something that you are required by law to have if you're going to legally operate a motor vehicle in the United States, or at least the states that I've lived in. I can't speak to every state. Now, here is the long-term trend line of CPI. And this has the same look to it, but we see that the 10-year CPI has been on the core level 3% annualized, and the PCE has been 2.5 annualized. The 20-year number on the PCE is right on top of the Fed's target of 2%. It's 2.1% for the 20 years. And we look at the core CPI, and it's at 2.4%. It's elevated because these dotted lines are 2% trend lines. We've been rising from 2006 until 2022 at about that 2% level on an average basis. And now we're way up at this spike. And so again, we would need this to go sideways for quite a while for us to catch up to that red line. It looks to me like it might take 4 or 5 years. So here we are with U.S. home prices versus disposable income per capita. And here's another one for the inflationists, because we see that home prices have gone straight up and they're not stopping. It looked like they maybe were taking a break there a year ago, but we see that the Case-Shiller National Home Price Index is at a new high, and it's risen in a lot of places, surprisingly, like Los Angeles and Manhattan, not surprisingly, but Los Angeles, I think, surprisingly, by about 8% over the past 12 months. And you can sort of see those are substantial areas that drive these numbers. And we can see that we are been way off to the races, really, since the end of the global financial crisis, but on steroids since 2020. Now, the problem that the consumers are feeling is disposable income is now way out of whack on a trend basis versus home prices. Frankly, it looks like, God forbid, 2006 type of affordability, where disposable income is completely lagging the Shiller Home Price Index. And this is why we have such a sluggish housing market, no doubt, and particularly, and also higher interest rates. We're stopping that. We'll see what happens now that mortgage rates are down 100 basis points from their highs and perhaps can go lower. It's our opinion at DoubleLine that if we get to a sub-6 mortgage rate, it might start to unlock some of that ossified supply because buyers didn't want to switch to such a high rate mortgage. If we can get down into the fives on the 30-year amortizing mortgage, that might unlock supply, which might take home prices down. So it's not clear to me. This has a feel of inflation, but also has potentially to portend some stabilization or even declines in some areas of the home market. I know that some of the areas that were emigrated to, like Austin, Texas, and Miami, and parts of Florida, I know that some of those areas are actually having deflation in the home market because of the tremendous overinvestment during the lockdown. And now, if you're an inflationist, I got one more chart for you. Global shipping rates with a 6-month lag. Global container rates are the blue line, and they lead. This is a 6-month lead on the blue line versus the black line, U.S. PPI final goods. And that has bottomed out, as we saw on the chart. And there is a good correlation here. So maybe it's possible. I don't really predict that it's going to happen, but it's possible that if you're an inflationist, you've got something to lean on here. Almost all of this inflation section supports the Fed's increased confidence that they've been making the appropriate progress on the inflation rate. Now, this is a 1974 Matador, and I'm going to talk about are we in a recession or not, and I'm going to talk about are we really being shown accurate data. The Matador was, some people have a great fondness for this car, 1974 AMC Matador. There are some people that think this is the most beautiful car ever made. I am not in that camp. I am actually in the camp, this is one of the ugliest cars ever made, and really symbolic of the sort of malaise era on the 70s into the middle 80s. Late 70s into about 1980. And what's funny about Matador, I remember this when I was a kid, they advertised the 1974 Matador in the first commercial by showing it with a sheet over it. The car, in my opinion, was so ugly that the Madison Avenue advisors for the commercial said, this car is so ugly, we've got to try something gimmicky. And they actually put a cape over it. I'm of the opinion that's why they called it a Matador. They go, oh my gosh, this turned out so bad, we got to cover it up. And like a Matador's cape, he had the sheet over it. And then this neighbor comes over to the guy who's got the sheet over his car, and he says, what's this? You got a new car? And he rips the sheet off and he says, it's a Matador. And I thought that was really funny because it's sort of like they were reluctant to show you the car and they were more comfortable covering it up. And then, shocker, here's this car that they're advertising. So let's talk about some things in the economy and are we covering stuff up? Well, first of all, let's one more thing on the Fed. This is a recession indicator for sure. The U.S. yield curve is steepening before the recession. The 2s, 10s got to a negative 108 basis points at its maximum inversion, and now it's positive 6. And you can see in past recessions going back to 1980, or 1984 for that matter, you can see that the curve de-inverts before the shaded areas every time. So we did not give a false signal on recession by the yield curve being inverted. The recession signal was only given this week with the 2s, 10 spread going positive. I'll acknowledge that the spread is not very positive, so we'll see if this endures, but you'll notice historically that when it de-inverts, it tends to de-invert very much further from the zero line, hundreds of basis points. And I believe that will happen again, but perhaps not initially to the same extent that it has typically historically, because the 10-year has already rallied so much. I think the surprise here that this took so long to de-invert is that the 10-year rate was falling pretty much in sync with the 2-year for a while, but now the 2-year rate has been falling faster. Here's the old consumer confidence versus for expectations versus the present situation. And you'll notice that the tannish line has been deteriorating on a trend basis. It had been holding up and going sideways, while the view of the future, the dark line, had been deteriorating. But now the view of the future has stabilized, and the view of the present is now the one that's deteriorating. And that causes the red shaded area to start to shrink. And you'll notice in the past 3 recessions, when the red shaded area starts to shrink in earnest, you're on the front edge of a recession or slightly past the front edge of a recession. We might be a data point or two away from being definitive on this, but it has certainly started to shrink in a definitive way over the past year or so. So this has us on recession watch. Here's the leading economic indicators, which have not worked at all. That's because they're so manufacturing oriented, and manufacturing got weak early on into the lockdowns after the first initial surge of 2020 and 2021 of people buying manufactured durable products. Now we see that the leading indicators for 12 months has been negative for like 2 years. And the 6 months annualized has been negative for even longer than the 12-month, and they're still negative. But this has not worked very well. One thing I want to show, let's look under the hood of the most recent report on the economic indicators. It's a little bit harrowing, quite frankly. We'll see that there are only 2 components that were up in any significant way. And those were stock prices and the leading credit index. Well, stock prices have stopped going up. The S&P 500 isn't even up since the last Fed meeting, July 31st. But everything that's really kind of important looks like it's negative. So what they call the dispersion of the leading economic indicators has gone back to a negative situation. A couple months ago, we had a month where there were 6 that were positive and 4 negative. Now the negatives far outweigh the positives in magnitude and even in number. Now the Fed has this other mandate, and they call it the labor market. And Jay Powell has been using the term that the supply demand of labor has come back into better balance. And what I think he's talking about is the bottom panel, where we see those green bars. And those green bars were so elevated because the yellow line in the top panel was, really far. The orange line on the top panel was really far above the blue line, and so labor was out of balance. Supply was less than demand, but now they've come more in line. And when he says it's back into balance, it kind of looks like it was pre-pandemic, pre-lockdown, which was a labor market which seemed to be functioning fairly well. But I'll tell you one thing: the trend here, it might be in balance, but the trend here is a little bit troubling. You can see those green bars are going down almost monotonically and have been for over 2 years. And so is this really going to be, is this trend going to continue, which would lead to even more pressure on the Fed to ease rates more aggressively? Well, let's look at some employment trends and see if that's justified, that logic that maybe we're going to go into a balance where we have more supply of labor than demand for labor. Well, here's our old friend, the unemployment rate, the U3 unemployment rate versus its 36-month moving average. And we've always said that when it crosses over, the blue line crosses over the tan line, that's strong evidence they're at the front edge of recession. Look at the last 3 recessions. It's almost a perfect indicator. Well, guess what? We've crossed over, and you don't need a magnifying glass anymore. It's definitive. We're not only above the low of the unemployment rate by 50 basis points, we're almost above the 36-month moving average by 50 basis points, which is virtual guarantee of recession. So this trend is not favorable at all for the Fed if they want the labor market to stay at the present supply-demand relative balance. And here we've got this overlaid against the recessions going back to 1953. The blue shaded area is the middle 2 quartiles leading up to the recession. So we're taking out the tails, the top quartile, and the fourth quartile. We're just taking a look at the observations in the middle. And the yellow line is the median of that blue shaded area. And we've got 2024 on here. And it sure looks to me like we're following the median of the recessions. In fact, this suggests, just this one variable, that we are already 4 months into a recession. On CNBC on July 31st, I said, my work shows that the history books will say with high confidence, I say the history books will say that in September of 2024, we were in a recession. And here's it's a matador that the government seems to be pulling. They don't want to show you things. These are the benchmark revisions. And here we are on non-farm payrolls. And we see that there's been a lot of downward revisions. If we go back for years, we've got very few upgrades compared to downgrades. So it looks like they've been over-reporting non-farm payrolls, only having to adjust them lower. And it's not just this employment report, it's also the household survey, where they've now had 6 out of 8 months of jobs, 6 out of 8 months of jobs being lost, full-time jobs in the household survey. And year to date, we are now negative on employment. We have employment shrinkage on the household survey cumulatively here through the first 7 months, coming up on 8 months of 2024. Part-time jobs have been a little bit better, but there's plenty of evidence that many people have 2 part-time jobs. So it's not like a person wants to have 2 jobs. They have 2 jobs because they need to have 2 jobs. And so if you've had 1 job and now you are driving an Uber as a second job, that's not exactly great job creation. That's people getting jobs out of economic necessity. So let's focus on full-time employment. And it looks like it's a matador. Here's some forward-looking indicators. We're just comparing the quits rate, which is the tan line, and we've got it plotted 8 months leading the Atlanta wage growth tracker. And the Atlanta wage growth tracker has been falling. It's down by about 200 basis points from the high, but the quit rates, there's a high correlation here, as you can see. The quits rate suggests that we should see further improvement in the wage growth. So that would be another variable that would put us maybe sustainably for some months below 2% on the headline CPI should oil stay at this level. That's a big caveat because a lot of this inflation news has to do with commodities and in particular oil. Here's another bad trend for the labor market. Average weekly hours worked in manufacturing, clear downtrend. The tan line had been falling anyway. Then the pandemic came, but now we're going to new local lows. And first, there's an old adage, first they cut the hours, then they cut the bodies. This has been enough of a decline that it's starting to have the look of some of the past recessionary periods. And here's the trend in initial claims. Initial claims is that blue line. We've got the moving average, just smooth out some of the noise, is that darker blue line. It has gotten a little bit better in the last couple of weekly readings, but it bottomed out a while ago. And on a trend basis, it looks like it's gently rising. I think this is an absolutely critical indicator to watch. The unemployment rate and the continuing claims that give you some insight into what the unemployment rate might be doing. The initial claims, just as a reminder, come out every Thursday. So that's it's every weekly data, so we get a high frequency look at things. But look at continuing claims. This is not really improving. It's not terrible. It's kind of going sideways. So we'll be following these indicators. And one more thing, I'm not talking much about the budget deficit today. I'm sure some of you are glad about that, but here's one chart on the budget balance, which is a deficit of 4.2%. I've got that plotted against the unemployment rate. And if this unemployment rate trends this way, we can expect, for good reasons, the deficit to get even worse. The deficit's already at 5.5% of GDP. That's pretty bad. The unemployment rate's at 4.2, but we're not in a recession, supposedly. So we'll see what happens. I mean, typically when we go into these recessions, we can see the budget deficit gets way worse. That shaded area gets way worse by multiple percentage points. So let's see what happens to the deficit. That's going to be a big problem for bond supply if this budget deficit increases. I saw one of the questions from my friend Ed, what if we have a failed auction? in the Treasury market. Well, Ed, that would be bad. And a failed auction would be the signpost that we might have rising interest rates in the next recession after the initial decline in yields, which has already been happening. We've already had the 10-year yield come down from the high of 502 last October into now, less than a year later, down to about 3.65. So it's already had a rally, but will the rally continue if we have to have all this big bond supply? I don't think so. So it's critical to see what happens with the deficit. A failed auction would obviously be the opening salvo of the market realizing that perhaps the next recession will have so much bond supply that after initially falling, which is provable because it's already been happening, perhaps it will reverse and we could have the unthinkable. We could have rising longer-term interest rates in a recessionary environment due to budget fears. We shall see. I think there's a good Byron Wien type of surprise thing. I'm not saying it's a 50% chance, but I think it's more than the 10% chance that most people would give to the idea that the long end of the Treasury market yields might go up sometime when we get deeper into the recession that I think we may have entered already. Here's the CBO, which is wildly optimistic on their projections. They project lower interest rates than are likely. They project lower deficits than we're even already having. And by necessity, they predict that there'll never be any recession. But here's their prediction of federal net interest expense as a percentage of tax revenue using the present tax system. And of course, it's been going vertical, and we're going to be up to about $75 billion a month in interest payments here very shortly. We're already at about $3 billion a day of interest expense. So here we are. We see this strange little hook on the dotted line projection. That's assuming that the Trump tax cuts roll off. There would be a small revenue increase temporarily for a couple of years, but then the mathematics of the deficit and the compounding of interest take over and the trajectory continues. I suspect that if Trump wins, the tax cuts will maintain and that will make this projection even more optimistic. But even this shows that we have something like 20 to 25% of tax revenue going to interest expense. That is far too low because the assumptions are pretty much universally optimistic. Here's the Treasury market. Here we see that Treasury rates bottomed out and have definitively broken out of their trend line. We got the solid line and we got the red line is 2 standard deviations up and down. And I don't know, one way to think about this is maybe we'll go down on this rate rally. It's possible that the terminus is somewhere down there at about 3.4, 3.25 on the 30-year. That would be maybe 75 basis points of room. And maybe at that point, we stall out. Maybe at that point, the dynamics of the deficit and the interest expense will take over. For now, it looks like we're in a rally mode for long-term bonds. And I said at the top of the webcast, really the best performer since the past few Fed meetings, from those meeting days until today, have really been long-term treasuries. They've outperformed stocks, they've outperformed commodities, they've even outperformed gold. Speaking of gold, here's what's not working. The copper-gold ratio, which if you go back to prior to COVID, we see the copper-gold ratio worked pretty well. Directionally, they were almost in lockstep, and when it would diverge, they would come back to a convergence. And that even happened post-COVID, where for a couple, 3 years, there was a big divergence, but then it was closed and it converged again. But now we're coming on a year and a half where the copper-gold model is of no value whatsoever. And I think the reason is that now that we've turned the corner perhaps on interest rates and we don't have secularly falling interest rates anymore, and that we have mismanagement of developed economies, and we have very strong suspicions of our institutions and our elites that run them, we're getting to the point where I think people are worried about what's happening now that the fourth turning has begun, and we need to restructure our institutions and our economic and potentially our political system. That should make people concerned about being careful not to extrapolate patterns from the past into the future when the institutions that have been central to the past over the past, 7 decades or so, 8 decades, are going to be replaced, going to need to be replaced, because we can all see that the systems that have been in place are being rejected on many, many levels. And I'm sure I don't have to go into that. in any detail. So what's better than the copper gold model now seems to be Texas Intermediate crude, WTI, where directionally they look pretty similar. And you'll notice that WTI and the 10-year have been moving directionally kind of identically for the past 2 years. And in pretty much directionally also from COVID into the peak in WTI back in 2022. The bond yields peaked a little bit later, but I'm going to be showing WTI more frequently as it now seems to be a variable worth noting. I got 3 more slides, and I'm going to turn it over to go through the specifics of the fund. We've got Ken Shinoda with us today. Ken has been a portfolio manager for years on a total return fund. Andrew Sue has been going through that section of the webcast, but we've got Ken, and we're happy to have him doing it today. He'll handle it slightly different. So we'll see some new insights, and I'm sure they'll be valuable. So let's just very quickly go through some basic, big picture things on markets. Here's the stock market. And we say that the S&P 500 had outperformed the Russell 2000 for basically 14 years, particularly 10 years after 2014, reaching a relative valuation level rivaling the pre-dot-com bust situation. And it looks to me like that's happening again. So we have what looks like a double top in the S&P outperforming the Russell 2000. It's not definitive yet. I think you need to break below. Your mind can draw kind of a trend line with that great big movement since 2021 into 2024. But we'll watch and see. I feel that based upon the sentiment in the market, the valuations in the market, the fact that this chart is double topping in the context of an AI frenzy, which feels quite a bit similar to the dot-com frenzy. I'm not saying AI won't have a long life and have many profitable companies, but it sure looks like it has the valuations today that you had for the dot-coms back in 1999, which is really not a good thing to be owning. Here's US S&P versus MCI Europe. And it is not underperforming. It's basically been performing with volatility in line, going back nearly 3 years. So if you own Europe versus the S&P 500, if you're a dollar-based investor, you have to think about whether you want to own that in dollar terms or currency terms. I would own, as a dollar-based investor, I would own foreign markets in local currency terms. I don't know if it's going to work in the next year. I don't know if it's going to work in the next year and a half. But I think it's going to work over the next decade. And so sometimes you have to just go with the longer term picture, not worry about the short term performance, because you don't want to lose sight of the forest for the trees. And here's the last one, it's emerging markets. This only goes back a couple of years, but we have stopped the underperformance of emerging markets versus the S&P. And it stopped back when the real outperformance of the Magnificent Seven hit its apogee. Although there's been some enthusiasm there again, we see that emerging markets are now in line with the S&P 500 on the MSCI. With that, I'm going to turn it over to Ken Shinoda to go through some of the facts of the fund. We're pleased that the fund is performing extremely well this year, and Ken will go through some of the reasons why.
All right, thank you, Jeffrey. Let's take a look at a return attribution of where we're getting our returns from. This is through August 31st. On the left-hand side is DBLTX. We've got the US Ag in the middle and the difference, the excess return. And this is on a gross basis for DBLTX. So the top line near the bottom, we first look at spread return. So this is the benefit of asset spreads tightening. Both the agency mortgage book has enjoyed some spread tightening. It was one of the laggards of the market last year. We've been talking for many months, almost a year plus, about how cheap agency mortgages have been relative to their own history. And that's finally starting to work as the Fed's getting ready to cut rates. So you can see that we have about 30 basis points of excess return because of the spread tightening on a mix of both the agency mortgage book and the credit book. The next line item is a curve return. This is our return related to movements in the interest rates. You can see about 60 basis points through the year, through August for DBLTX, only 20 basis points for the ag, for 40 basis points of excess return. we've got an underweight to the long end and a bit of a 230 steepener on that's been working really well very recently, with the front end of the curve coming down relative to the long end, seeing that inversion that we've seen in short and long-term rates finally turn positive again. And last but not least, the carry, or the return from the yield of the portfolio. You can see DBLTX, we've had a very high yield advantage relative to the index, returning 370 through August versus 250 for the index, for 120 basis points of excess return. Combine it all together on a gross basis, we've outperformed the index by about 190 basis points. Now, this is through August. As Jeffrey noted, it's been a pretty strong September. The market has continued to rally. The index is up about almost 150 basis points through last night. DBLTX is up about 160 basis points. Much of that has to do with the higher quality parts of the fixed income market. Credit has rallied as well. Our credit through month to date is probably up somewhere between about 60 to 80 basis points, depending on the sector. But the agencies and treasuries are up over 200. So it's the winner has been having that duration on, but it's been a good ride for fixed income, negative through kind of the middle of the year, and then finally coming into some pretty solid green numbers, mid to high single digits for many parts of the fixed income markets. Now let's look at a snapshot of the portfolio as it stands today. In the top left, some basic metrics. Still have a nice discount in the fund, discount in the bond market broadly. So we don't have that convexity risk or that call risk when bonds are up over a premium dollar price, over 100 cents on a dollar. So as rates fall, we still have this nice discount in the portfolio and the bond market broadly. We very recently shortened our duration a little bit, so you can see that we're about 0.37 years short of the index. The index has a duration of 6.16. We're sitting today, or through at August 31st at 5.8. We had a pretty ferocious rally across the curve. So take our interest rate duration down a little bit. We think we might see a little bit of a backup. Maybe the market's gotten a little ahead of itself on this expectation of rate cuts. Yield to maturity, still a very attractive yield advantage to the index, 562 for DBLTX versus 442 for the index, almost 120 basis points. We have some of the largest yield advantages in active bond funds versus indices that we've seen in many, many years. So the prospects for active management are very, very interesting right now. Obviously, when we were at a very low interest rate environment 4 or 5 years ago, it was very hard to create excess return. But given the reset in yields and spreads and these high absolute yields we're able to achieve, creating more diversified portfolios going out of index, the future returns continue to look bright, I think, for active management of fixed income. Now, digging a little deeper, we still have our core exposure to agency mortgages, treasuries, high quality parts of the fixed income market. In the top right, you can see that combination of government guaranteed or government backed. These are those Fannie, Freddie, Ginnie Mae mortgage-backed securities, with our treasury exposure, which is on the lower end today, about 3.37, makes about 58% of the portfolio. 41% of the portfolio today is credit. It's in a mix of securitized credit, so no corporate bonds, the largest of which is that residential mortgage-backed securities, or most of us know that as non-agency mortgage-backed securities. These are not guaranteed by the government, so you're taking on that additional credit risk. They've had a great run this year. Some parts of those markets had lagged last year, along with agency mortgages, but the mortgage market is making a comeback, and you can see that in the returns. And we think there's still some more room to run, especially relative to corporate bonds, both investment grade and high yield, that saw a bulk of their spread tightening last year. And we've been talking about this securitized and mortgage catch-up trade, and we're enjoying the benefits of that this year as those markets continue to rally and play catch-up with those corporate credit markets. CMBS, non-government guaranteed commercial mortgage-backed securities, comprise it's about 7% of the portfolio. They've also been playing catch-up, so seeing strong returns there. I think they're up about 7% on the year in this portfolio. And we're at the top of the capital structure in these securities, very low credit risk and very low office exposure. The aggregate office exposure at the portfolio level is only 1.5%. and the team does deep dive underwriting in that CMBS market. CLOs, next biggest part of the portfolio, 4.7%, largely AAAs and AAs. They had a great run over the last couple of years. It was CLOs and floating rate in general, like bank loans, have been one of the better performing parts of the market. But as the market turns from the hiking cycle to the cutting cycle, and as rates now start coming down, the fixed rate market has started to outperform those floating rate assets. But in the meantime, they still have attractive carry and will generate good carry for the portfolio until the Fed cuts more aggressively. ABS, a little under 5% of the portfolio, a mix of consumer-related assets and hard assets, also has done well. Most of the credit in the portfolio is up about 6 to 7%, which is kind of in line with the high yield market. So we got high yield returns this year with much higher quality credit as the yield advantage that we have in those sectors plays, and the spreads that were wider than corporates play catch up. Bottom left side of the portfolio, you can just kind of see the different allocations and yields of the different sectors. This is again through August 31st. Rates have fallen since here, so yields are a little bit lower. But high quality parts of the market, agency mortgages, you're getting kind of that 5% type return, 5.5% for agency CMBS. And as you go into the credit markets, depending on the risk you take, somewhere between 5 to 7% of credit markets. Moving on. This shows you the mix of the high quality parts of our portfolio, the different types of agency mortgage-backed securities, traditional pass-throughs, what are called agency CMOs, which are you take a pass-through and you can slice it in different tranches to take the prepayments either sooner or take those prepayments later. And this just shows you the active management across moving across the different parts of the market. Very recently, we've been selling CMOs that have tightened that we bought last year when SVB was dumping them in the marketplace in the FDIC sales, taking some profits there, moving back into pass-throughs, but really wanting to show that when spreads got very tight, 2021 was probably the tightest mortgage spreads that we've seen in decades. And we took the MBS exposure down to the lowest it's been in the portfolio. We're always going to have some MBS exposure by prospectus, but you can see we took it down to some of the lowest levels that we've ever had. And as spreads widened into 22 and 23 to kind of the widest spreads that we've seen in over a decade at least since the GFC, we've added that agency exposure back, and now we're towards the higher end of the exposure in agency mortgages, and we're pretty. We think the future prospects are good. So as we look at the next slide, which shows you just how low those spreads got back in 2021. The blue line is the spread on what's called current coupon mortgage-backed securities. These are brand new mortgage bonds getting packaged at whatever the new prevailing mortgage rate is. And the gray line is the B of A move index. The move index is the volatility of interest rates. And mortgage spreads are highly correlated to rate volatility. So when rate volatility was very low, you can see mortgage spreads got very tight. That was kind of peak QE when we were doing QE infinity back in 2021 post the start of the pandemic. And you can see just how tight mortgage spreads got, almost 50 basis points for current coupon. And then we go into the rate rise regime. We go into the great bear bond market, 22, 23. You can see rate volatility spiked and mortgage spreads spiked with them to levels we really haven't seen since the GFC. There was a brief moment where we thought Fannie and Freddie were going to go under, where we saw spreads a little bit north of 200. That didn't last for too long. But since then, that 200 area has been a pretty good upper bound. The shading that you can see here, the light shading was when we took our mortgage exposure down. And then the other shading on the right towards 2023 is when we started adding back more mortgage exposure up in that kind of 175 to 200 area. We've made the first leg down with mortgage spreads. Part of that has to do with the Fed going to start the cutting cycle. Part of it has to do with rate volatility having come down. And then there's going to be another move lower, we think, when the banks come back more meaningfully, which will happen as the Fed cuts, because they'll finally, after a miserable almost 2 years, they'll finally have a positive sloping yield curve because they buy mortgage bonds on a levered basis. And when your asset yields less than your financing costs, it's not really a great investment. So we think that there will be another move down in spreads. We like the exposure we have, and we expect to benefit from that in the coming months and year, perhaps. All right, moving to the next slide. We looked at yields a little bit earlier on the credit side of the portfolio. Instead of owning investment-grade corporate bonds in DBLTX, which many intermediate-term core funds or core plus funds own, even our own core plus strategy, we own corporate bonds. We own in DBLTX only securitized. So the yield advantage on our high-quality securitized credit portfolio is pretty attractive relative to the investment-grade corporate bond market. As I mentioned earlier, the securitized markets have lagged the corporate credit market a bit. They also sit at the front end of the curve, and when the curve was inverted, we also had a yield advantage because of that inversion. Now, that inversion is gone now, but that spread advantage is still there. I looked right before the webcast. Corporate bonds yielded about 475 for the investment-grade corporate bond index, and the credit portion of DBLTX as of last night yielded around 640. So almost 170 basis points of extra yield in our credit portfolio relative to the investment-grade corporate bond index, giving us that all-in yield advantage, again, of about 120 basis points versus the index, which should help us generate excess carry in the future to help us outperform. Moving along. Duration of the portfolio, DBLTX is in the blue. The 10-year treasury is in the dashed black, and you can see the index up over in yellow. We are the longest duration relative to the index that we've been almost since inception, because rates are frankly the highest that they've been almost since when we launched the total return fund. You can see in 2010 for a brief moment, the 10-year treasury was at 5, and then we kind of at 4, and we haven't really gone up to that 4% level since we launched DBLTX. And so we've enjoyed this long duration into the rally. We've seen a pretty ferocious rally. We're sitting here at this kind of 365 area level. We briefly touched that in early August in that bout of volatility, and we think the market may have run a little bit too far, too fast. So we've ever so slightly shortened our duration. We still have that steepener on, which is working well, given the movement on the front end. Thought I'd just touch on some slides related to the underlying credit assets that we own. We have a 25% exposure to non-government guaranteed mortgage credit. As I think we all know, and Jeffrey mentioned earlier, housing has done really well, and it's done well really on the heels of very low inventory. You can see the gray line is inventory of existing homes available for sale. We hit an all-time low around 2021. We've come up a little bit, but we're a little under 1.5 million units of existing inventory. And this is really the main reason that home prices haven't really gone down much, even though rates went up from 3% on mortgage rates to almost 8% in a couple of years. And it's that low supply that has really supported housing. So lower rates may actually thaw the housing market, as Jeffrey was talking about earlier. But it might incentivize people that are locked into a low coupon mortgage that want to move to maybe finally make that choice. But what does this mean for the bonds that we own? Well, most of what we bought, we didn't buy today or 6 months ago. Most of what's in this portfolio was purchased over the last decade. So the borrowers have been paying their mortgages down, principal, and maybe even some prepayments, and they've enjoyed tons of home price appreciation. I mean, from the start of the pandemic, home prices are up over 40% nationwide. So there's a ton of embedded equity, and we think that even if we see a slowdown in the economy and rising unemployment, the probability of default and loss is very low, because if you lose your job, you could sell your house and you're probably going to make money. You're going to take that equity and cash it out. Alternatively, the pandemic really led us to doing nationwide forbearance programs, where it's highly likely if we see a recession that we'll do the same forbearance programs where borrowers can miss a certain amount of payments. We went up to 12 to 18 months during the pandemic, which really helped limit losses in the mortgage market, and we think that's going to be the case too. So while we're not necessarily bulled up on home prices, given the potential for supply as rates fall, we're still very bulled up on the outlook for the performance of the borrowers in the bonds that we own. CMBS is the second largest exposure we have in the portfolio. We think that that potentially we've seen the worst in sentiment behind us for sure. The worst in sentiment was the summer of last year, when we were in peak higher for longer fears. As rates start coming down, the outlook for commercial real estate continues to improve, and we've actually seen prices start to stabilize in some of the indices. This shows you the payoff rates by property type, going back through time, meaning this is a loan that is hitting its maturity and the borrower is then refinancing. And usually, if they can refinance when they're supposed to, or they can pay off your loan and maturity when you're supposed to, it's a good thing. So not surprising, industrial and multifamily have had the best kind of historical payoff rates. Office has been on the lower end. In 2020, hotel was obviously at the lowest end because of what's going on with the pandemic. But what we're seeing is basically kind of a surprise to the upside. Given how high rates are, we had expected, or the market had expected, a much lower payoff rate for certain parts of the commercial real estate market. And what you're seeing is that you're getting more refinance activity than we thought we would. Part of that has to do with because the rate market has stabilized, the CMBS market had opened up, and borrowers are willing to lend. Office, of course, is on the lower end with the challenges it has, but industrial and multifamily it seems almost unfazed. So the commercial real estate market is a very geographic, specific type industry. It's all about location, borrower. So our team kind of digs through the underlying loans to analyze and see what the payoff potential is for our assets. Next slide, please. These are delinquencies across the different CMBS markets. You can see they peaked after the pandemic, and they've been kind of making their way down. You would have expected these delinquency rates to maybe tick up a little bit, but it's stayed very stable and continues to come down. Consumer delinquencies. Our mortgage bonds are backed by the consumer, so we want to always take a look at what's going on with consumer credit. Also gives us insight into the state of potential consumer spending and problems of the economy. And of course, in the ABS book, we have exposure to things like credit card loans, auto loans, student loans, and other types of consumer credit. And you can see the delinquencies definitely have been on the rise. I think Jamie Dimon was speaking earlier today about consumer delinquencies on their book. Also, Ally Financial, which is a large auto lender, reported earnings this week, was also talking about an increase in auto delinquencies. So delinquencies are definitely on the rise. It's something to keep our eyes on. They're even ticking up a little bit above pre-pandemic level, but maybe not a shock given the pressures of inflation on the consumer. But it's interesting. It's demographically biased. Not surprising, perhaps. The younger consumers tend to have a higher percentage of delinquencies. It's on the next page, where you can see that age 18 to 29 bracket delinquencies are higher than obviously people with more savings, some more experience dealing with debt. But it's a mixed story, and that's where you see underemployment is in that the younger age bracket. It's harder for them to find jobs, or maybe they're in part-time jobs, and so it's not surprising to see higher delinquencies there. So something to keep our eyes on is the rising delinquencies. The next slide shows the same theme on auto loans. We're going to get to the auto loans. This just shows you how much money banks are making. The bottom line is the charge-off rate. So those are the percentage of loans that are taking losses. That dipped below the recent average as the stimulus checks went out post-pandemic. It's kind of normalized back to this kind of long-run average charge-off rate of 3.5%. That's a little bit below the current unemployment rate, which also makes sense. And then the APR margin is the margin above the prime rate that people are getting charged, and prime is at 8%-ish on its way down as the Fed cuts. So this is a pretty high margin relative to that loss rate. So pretty good loss adjusted returns at the banks as they've risen their credit card rates relative to their charge-off staying at reasonable levels recently. This is auto loans, that same look across age bracket. The absolute percentage is much lower, but the theme of the different age brackets is the same, as younger borrowers seem to be struggling more. They're on the lower end of the pay spectrum. They're going to be squeezed more by inflation. So it's not surprising to see that those younger cohorts are seeing more stress from a delinquency standpoint. Last but not least, just to look at a snapshot of delinquencies relative to what we call credit enhancement. This is the percentage of bonds below you that must take a loss before you get hit. And we have very high quality credit in DBLTX. You can see, for example, in the ABS and CLO book, less than 1% of delinquency and 20 to 30% of subordination. CMBS has and RMBS have a slightly higher percentage of delinquencies, but you have to remember there's assets underneath. So when those assets get liquidated, you may see no loss in the case of some of the residential assets, given the loan to values and home price appreciation, or the loss as a percentage of delinquencies could be very low. Still tons of coverage, up at that 28% for RMBS and 22% for CMBS. The only one that needs a little bit of explaining is legacy RMBS. That's about 12% of the portfolio. These are those seasoned bonds from the pre-GFC. They trade at deep discounts, and they have lots of seasoning in them. And the discount is almost the subordination, in the sense that we are pricing these all loss adjusted, expecting to take some delinquencies and foreclosures, but backing out to about, today they trade around a 250 spread to treasuries. That's over 100 basis points of spread pickup to investment grade corporate bonds for loans that have borrowers that have made payments since 2005 and 6 now. They've made it through the global financial crisis. They've made it through the pandemic. They made it through this last bout of rates rising. So really solid seasoned credit in that legacy book. So hope you enjoyed some information about the Total Return Fund. We'll turn it back to Jeffrey Gundlach for questions.
What about tips versus regular treasuries? I'd stay away for the next 6 months. Tips are probably underestimating or overestimating actually what the inflation rate on the CPI is going to be. And so I think tips will be under pressure if the CPI starts printing a one handle. Someone says, how long till the Fed reduces to zero? Well, if they're going to go to zero, I think it would be fairly quickly. I'm not sure they have the idea to go to zero. I think they've learned that zero is not that great. But I'm certainly open to the idea that we'd go back to the same playbook and do zero in quantitative easing. I think it would be inflationary. It's one of the reasons why I think we might have problems at the long end and problems in the dollar. And someone says, can I reconcile the fact that the NFCI indicates the Fed is being accommodative when I talked about them being restrictive? Yeah, it has a lot to do with market inputs into some of these indices, like the VIX index, which is not really very high right now, like stock prices themselves. So I really don't like those indicators. I think that they have to do with markets more than the economy. So I think the Fed is restrictive. So with that, well, the Bills managed to eke out their win 1-0. I doubt they'll be undefeated this year, but hope everybody's enjoying the NFL, and we'll look forward to the next webcast, which is in December, as we wrap up the incredibly fast-moving year of 2024. With that, thank you for your support, and goodbye for now.